Chapter number 7. Net Asset Value, Total Expense Ratio and Pricing of Units. In this chapter, we will cover fair valuation principles and relevance for investors, computation of net assets of mutual fund scheme, dividends and distributable reserves, concept of entry and exit load and its impact on NAV, key accounting and reporting requirements applicable to mutual funds, NAV, total expense ratio, and pricing of units for the segregated portfolio. Understand all the concept properly, and if you have any doubt, please write in the comment section. Fair valuation principles. An investor in a mutual fund scheme is the beneficial owner of the units one has bought. Expand this further, and it means that the ownership of the mutual fund scheme is collectively in the hands of all investors at any point in time. At the same time, the investors can sell their units and new investors can buy. Thus, periodically the ownership could also change. In such a case, it becomes very important that any investor in the scheme gets a fair price for one's investments. In order to ensure such fair treatment to all investors, SEBI has laid down certain fair valuation principles. The asset management companies are required to compute and carry out valuation of investments made by its schemes in accordance with the investment valuation norms specified in the 8th schedule of SEBI Mutual Funds Regulations 1996. The primary objective behind the introduction of these principles was to ensure fair treatment to all investors, this including existing investors as well as investors seeking to purchase or redeem units of mutual funds in all schemes at all points of time. At the same time, the valuation principles also address the mispricing risk and reduce the vulnerability of the short-term debt-oriented schemes to redemption pressure. The 10 principles as laid out by SEBI are: Principle 1. Fair valuation reflecting realizable value of securities. The valuation of investments shall be based on the principles of fair valuation, that is, valuation shall be reflective of the realizable value of the securities or assets. Principle 2. Valuation methodology approved by Board of AMC. The policies and procedures approved by the Board of the AMC shall identify the methodologies that will be used for valuing each type of securities or assets held by the mutual fund schemes. Principle 3. Valuation in accordance with policies and procedures. The assets held by mutual funds shall be consistently valued according to the policies and procedures. Principle 4. Periodic review of valuation policies and procedures. The valuation policies and procedures shall be regularly reviewed at least once in a financial year by an independent auditor to seek to ensure their continued appropriateness. Principle 5. Valuation seek to address conflict of interest. The valuation policies and procedures approved by Board of Asset Management Company should seek to address conflict of interest. Principle 6. Disclosure of valuation policies in SAI document. Disclosure of valuation policy and procedures approved by Board of Asset Management Company shall be in SAI on the website of Asset Management Company, mutual fund, and at any other place where the board may specify to ensure transparency of valuation norms to be adopted by the AMC. Principle 7. AMC shall be responsible for true and fair valuation. The responsibility of true and fairness of valuation and correct NAV shall be of the AMC. Principle 8. AMC shall have policies and procedures to detect incorrect valuation. Principle 9. Documentation of rationale for valuation shall be maintained and preserved by AMC. Principle 10. AMC shall take into consideration prices of trades of same security or similar security reported at all available public platform. In addition to the above, a mutual fund may value its investments according to the valuation guidelines notified by SEBI. In case of any conflict between the principles of fair valuation and valuation guidelines, the principles of fair valuations detailed above shall prevail. Valuation. A mutual fund scheme invests the investor's money in portfolio of securities created and managed based on the investment objective and strategy of the scheme. A mutual fund investment includes securities, money market instruments, privately placed debentures, securitized debt instruments, gold and gold related instruments, real estate assets, and infrastructure debt instruments and assets. The NAV of the scheme will depend upon the value of this portfolio, which in turn depends upon the value of the securities held in it. The valuation of these securities to determine the net asset value has to be done in accordance with the valuation guidelines laid down by SEBI and MFI. Valuation of traded securities other than money market and debt securities. The securities shall be at last quoted closing price on the stock exchange. B. When the securities are traded on more than one recognized stock exchange, the securities shall be valued at the last quoted closing price on the stock exchange where the security is principally traded. C. Once a stock exchange has been selected for valuation of a particular security, reasons for the change of exchange shall be recorded in writing by the asset management company. D. When on a particular valuation day, security has not been traded on the selected stock exchange, the value at which it is traded on another stock exchange may be used. E. When a security is not traded on any stock exchange on a particular valuation day, the value at which it was traded on the selected stock exchange or any other stock exchange, as the case may be, on the earliest previous day may be used provided such date is not more than 30 days prior to the valuation date. Now we will see the valuation of the non-traded securities other than money market and debt securities. F. When a security is not traded on any stock exchange for a period of 30 days prior to the valuation date, the scrip must be treated as a non-traded scrip. G. Non-traded securities shall be valued in good faith by the asset management company on the basis of appropriate valuation methods based on the principles approved by the board of the asset management company. For the purpose of valuation of non-traded securities 56, the following principles should be adopted. First, equity instruments shall generally be valued on the basis of capitalization of earnings solely or in combination with the net asset value. Second, the non-convertible components should be valued on the same basis as would be applicable to be a debt instrument. Third, the warrants can be valued at the value of the share which would be obtained on exercise of the warrant as reduced by the amount which would be payable on exercise of warrant. Value of gold. The gold held by Gold Exchange Traded Fund Scheme shall be valued at the AM fixing price of London Bullion Market Association LBMA in US dollars per troy ounce for gold having a fineness of 995.0 parts per thousand, subject to the conditions mentioned in valuation guidelines issued by SEBI in SEBI Mutual Fund Regulations 1996. Next, value of silver. The silver held by the Silver Exchange Traded Fund Scheme shall be valued at the AM fixing price of London Bullion Market Association LBMA in US dollars per troy ounce for silver having a fineness of 999.0 parts per thousand, subject to the conditions mentioned in valuation guidelines issued by SEBI in SEBI Mutual Fund Regulations 1996. Computation of net assets of mutual fund scheme and NAV. Net assets of scheme. Net assets include the amount originally invested, the profits booked in the scheme, as well as the appreciation in the investment portfolio. Net assets increase when the market prices of the securities held in the portfolio increase, even if the investments have not been sold and profits realized. A scheme cannot show better profits by delaying payments. While calculating profits, all expenses that relate to a period need to be considered irrespective of whether or not the expense has been paid. In accounting language, this is called the accrual principle. Similarly, any income that relates to the period will boost profits, irrespective of whether or not it has been actually received in the bank account. This again is in the line with the accrual principle. Now we will understand with an example. Net assets of scheme. Investors have bought 20 crore units of mutual fund scheme at rupees 10 each. The scheme has thus mobilized 20 crores units multiplied by rupees 10 per unit, that is 200 crore rupees. An amount of rupees 140 crores invested in equities has appreciated by 10%. The balance amount of 60 crore rupees mobilized from investors was placed in bank deposits and money market instruments. Interest and dividend received by the scheme is rupees 8 crore. Scheme expenses paid is rupees 4 crore, and while a further expense of rupees 1 crore is payable. Now, how to calculate the NAV? The simple formula is unit holders fund in a scheme, that is net assets divided by number of outstanding units. In the above example, it is calculated as rupees 217 crore divided by 20 crore, that is rupees 10.85 per unit. Let us understand the computation of net assets of mutual fund scheme and NAV. The summation of these three parameters gave us the profitability metric as being equal to A plus interest income, B plus dividend income, C plus realized capital gains, D plus valuation gains, E minus realized capital losses, F minus valuation losses, G scheme expenses you have to minus. We will calculate the NAV for the particular example. Value of the stocks is rupees 230 crores. Value of money market instruments is rupees 5 crores. Dividend accrued but not received is rupees 2.39 crores. Amount payable on purchase of shares is rupees 7.5 crores. Amount receivable on sale of shares is rupees 2.34 crore. Fees payable is 0.41 crore. Number of outstanding units is 2.65 crore. Now, in this, how to calculate the NAV? NAV is equal to current value of investments held plus income accrued plus current assets minus current liabilities minus accrued expenses divided by number of outstanding units. So here NAV is equal to 230 plus 5 plus 2.39 plus 2.34 minus 7.5 minus 0.41 divided by 2.65 is equal to 231.82 divided by 2.65 is equal to rupees 87.48. So the NAV of particular scheme is 87.48. Mark to market. The process of valuing each security in investment portfolio of the scheme at its current market value is called mark to market. Issuing fresh units at the price lower than the NAV will result in the post-issue NAV coming down for all investors. Redeeming units at price lower than the NAV will increase the NAV for the remaining investors. Thus, marking to market helps investor buy and sell units of the scheme at fair prices, which are determined based on transparently calculated and freely shared information on NAV. Such mark to market based NAV also helps in assessing the performance of scheme and fund manager. There are the two more examples for how to calculate the NAV of the mutual fund scheme. Mark to market. The process of valuing each security in the investment portfolio of the scheme at its current market value is called mark to market, that is, making the securities to their market value. What happens if the portfolio was not marked to market and investors are issued units post NFO at the face value of the unit? Consider the following example. Unit capital is rupees 1 lakh. Face value per unit rupees 10. Number of units issued is equal to unit capital divided by face value per unit, that is 10,000 units. Net asset of the scheme is 1,50,000. Net asset value is equal to net asset of the scheme divided by number of units issued, that is rupees 15. Now let us understand the concept of mark to market by understanding two cases. Case 1. Assume an investor buys 100 units when the NAV is rupees 15 and units are issued to him at the face value of rupees 10. Post the purchase, the scheme's numbers will be as follows. Unit capital rupees 1,01,000. Number of outstanding units 10,100 units. Net assets 1,51,000. So by calculating it, the net asset value, that is NAV, will be 14.95. Case 2. Assume an investor redeems 100 units when the NAV is rupees 15 and the units are redeemed at the face value of rupees 10. Post the redemption, the scheme's numbers will look as follows. Unit capital rupees 99,000. Number of outstanding units 9,900 units. Net asset 1,49,000. So according to the calculation, the net asset value will become rupees 15.05. Issuing fresh units at price lower than the NAV will result in post issue NAV coming down for all investors in case 1. Redeeming units at price lower than the NAV will increase the NAV for the remaining investors is shown in the case 2. So let us understand total expenses in mutual fund scheme. Types of expenses. All types of expenses incurred by the asset management company have to be clearly identified and appropriated for all mutual fund schemes. Investment and advisory fees are charged to the scheme by the AMC. The details of such fees are fully disclosed in the Scheme Information Document, that is SID. In addition to the investment and advisory fee, the AMC may charge the mutual fund scheme with recurring expenses including marketing and selling expenses including agents' commission, if any, brokerage and transaction cost, registrar services for transfer of units sold or redeemed, fees and expenses of trustees, audit fees, custodian fees, cost related to investor communication, cost of fund transfer from location to location, cost of providing account statements and dividend and redemptions, checks and warrants, insurance premium paid by the fund, winding up cost for terminating a fund or a scheme, cost of statutory advertisements. In case of gold exchange traded fund scheme, recurring expenses incurred towards storage and handling of gold. In case of silver exchange traded fund scheme, recurring expenses incurred towards storage and handling of silver. In case of capital oriented scheme, rating fees. In case of real estate mutual fund scheme, insurance premia and cost of maintenance of real estate assets, excluding cost of development of such assets, over and above the expenses specified in Regulation 52 of SEBI Mutual Fund Regulations 1996 to the extent disclosed in the scheme documents. Listing fees in case of schemes listed on the recognized stock exchange. In case of schemes investing in exchange traded commodity derivatives, recurring expenses incurred towards storage and handling of underlying goods due to physical settlement of such contracts. Any expenses other than investment advisory fee and recurring expenses shall be borne by the asset management company or trustee or sponsors. Now we will understand the total expenses in case of fund of funds scheme. Investing in liquid schemes, index fund scheme and exchange traded funds, the total expense ratio of the scheme including weighted average of the total expense ratio levied by the underlying schemes shall not exceed 1% of the daily net assets of the scheme. Investing a minimum of 65% of assets under management in equity oriented schemes as per scheme information document, the total expense ratio of the scheme including weighted average of total expense ratio levied by the underlying schemes shall not exceed 2.25% of the daily net asset of the scheme. Investing in schemes other than specified above, the total expense ratio of the scheme including weighted average of total expense ratio levied by the underlying scheme shall not exceed 2% of daily net assets of the scheme. In case of an index fund scheme or exchange traded fund, the total expense ratio of the scheme, including the investment and advisory fees, shall not exceed 1% of the daily net assets. It's very important in exam point of view. The total expense ratios limits are mentioned in the tabular form. Now let us understand the total expense ratio limits in case of close-ended and interval schemes. The total expense ratios of equity-oriented schemes shall not exceed 1.25% of daily net assets of the scheme. The total expense ratio of close-ended and interval schemes other than schemes specified in clause D, that is above, shall not exceed 1% of the daily net assets of the scheme. In addition to the above mentioned limits, the following expenses may be charged to the scheme: brokerage and transaction cost which are incurred for the purpose of execution of trade up to 0.12% of trade value in case of cash market transactions and 0.05% of trade value in case of derivatives transactions. If the new inflows from beyond top 30 cities are at least the 30% of gross new inflows in the scheme or 15% of average assets under management year to date of the scheme, whichever is higher, funds can charge the additional expense of up to 0.3% of the daily net assets of the scheme. In case inflows from beyond the top 30 cities is less than higher of A or B above, the additional total expense on daily net assets of the scheme shall be charged as follows: daily net assets multiplied by 30 basis points multiplied by new inflows from beyond top 30 cities divided by 365 days into higher of A or B above. You have to divide by 366 days wherever it is applicable, that is in the leap year. The additional TER on account of inflows from beyond the top 30 cities so charged shall be credited back to the scheme in case the said inflows are redeemed within a period of 1 year from the date of investment. The additional expenses incurred towards different heads, that is A, investment and advisory fees, and B, recurring expenses must be utilized for distribution expenses incurred for bringing inflows from such cities. Now let us understand the total expense ratio limits in case of close-ended and interval schemes. Third, mutual funds are also allowed to charge any additional expenses incurred under the various heads of permitted recurring expenses and investment and advisory fees not exceeding 0.05% of daily net assets of the scheme or as specified by SEBI. However, the schemes wherein exit load is not levied not applicable, the above mentioned additional expenses shall not be charged to the schemes. Expenditure in excess of the said prescribed total expense ratio limit has to be borne by the AMC. AMCs need to be predominantly disclosed on daily basis the TER scheme-wise, date-wise of all scheme under a separate head, total expense ratio of mutual fund schemes on their website and on the website of AMFI in downloadable spreadsheet format. The next topic is the valuation of the perpetual bonds. Mutual fund invest in different types of debt instruments. Some of them have features that are subordinate to equity, which means that they absorb losses before equity. Many others are convertible to equity if a specific event is triggered and there has to for absorption of losses. Additional Tier 1 and Tier 2 bonds that are issued by banks are perpetual in nature fall under this category. These are also popularly known as AT1 or AT2 bonds. SEBI has imposed limits on the exposure that a fund can take to these bonds. No mutual fund shall own more than 10% of such types of bonds issued by a single issuer. In addition, a mutual fund scheme shall not invest more than 10% of its assets into such instruments. The scheme should also not invest more than 5% of its assets in such instruments of a single investor. Close-ended debt schemes can invest only in instruments that mature before the end date of the scheme. Due to this reason, this type of funds cannot invest in perpetual bonds where for the purpose of valuation it is considered that the maturity date is 100 years from the date of issuance. Dividends and distributable reserves. As seen earlier, in the calculation of net assets, investments are taken at their market value. This is done to ensure that sale and repurchase transactions are effected at the true worth of the unit, including the gains on the investment portfolio. Similarly, it was seen that income and expense are accounted on the basis of the accrual principle. Therefore, even though they may not have been received or paid, they are accrued as income or expense if they relate to a period until the accounting date. Unlike accrued income, which is receivable, it is only a question of time, and accrued expense, which is payable, it is only a question of time. Valuation gains in the scheme's portfolio may never get translated into real gains. It is not just a question of time. The securities need to be sold for the scheme to be sure about the capital gains, that is, the capital gains need to be realized. Since the investments in the portfolio are not yet sold, the gains in them are on paper. They are not realized. They will be realized when those investments are sold. Now let us discuss about the dividends. SEBI guidelines stipulate those dividends can be paid out of distributable reserves. In calculation of distributable reserves, all the profits earned based on the accrual of income and expenses are as detailed are treated as available for distribution. Valuation gains are ignored, but valuation losses need to be adjusted against the profits. The portion of the sale price on new units which is attributable to valuation gains is not available as a distributable reserve. There is no assurance or guarantee to unit holders as to the rate or quantum of dividend distribution that it will be paid regularly. The trustees shall decide the quantum of dividend and record date. The NAV will be adjusted at the end of the record date to reflect the payout of the dividend. The public notice should clearly state that the NAV will decline pursuant to the payout of income distribution cum capital withdrawal plan and any statutory levy. Failure to pay dividend by the stipulated time will lead to interest being calculated on delayed payment from the record date. Next, concept of entry and exit load and its impact on NAV. SEBI has banned entry loads, so the sale price need to be same as NAV, subject to deduction of applicable transaction charges, if any, as discussed. While charging exit loads, no distinction will be made among unit holders on the basis of the amount of subscription. While complying with the same, any imposition or enhancement in load shall be applicable only on prospective investments. The parity among unit holders on exit load shall be made applicable at portfolio level. No exit load will be charged on bonus units and units allotted on reinvestment of dividend. Exit loads have to be credited back to the scheme immediately, that is, they are not available for AMC to bear selling expenses. Now that the scheme cannot have any entry load, the sale price would be equal to the scheme NAV. Say for example, if an investor invests for rupees 25,000 in the scheme with the NAV of rupees 43.21, she will get 578.570 units, that is rupees 25,000 divided by rupees 43.21. It would be important to note here that the transaction charges would have no impact on the NAV per unit or price of purchase. These charges would only impact the cost for the investor. Next, key accounting and reporting requirements. The accounts of the scheme need to be maintained distinct from the accounts of the AMC. The auditor for the AMC has to be different from that of the schemes. Norms are prescribed on when interest, dividend, bonus issues, right issues, etc. should be reflected for in the accounts. NAV is to be calculated up to 4 decimal places in case of index funds, liquid funds, and other debt funds. NAV for equity and balanced funds is to be calculated up to at least 2 decimal places. Investor can hold their units even in fraction of 1 unit. However, current stock exchange trading systems may restrict transacting on the exchange to hold units. The frequency of disclosures of NAV, portfolio and scheme account was discussed earlier. NAV, total expense ratio, and pricing of units for the segregated portfolio. AMC shall not charge investment and advisory fees on the segregated portfolio. However, TER, excluding the investment and advisory fees, can be charged on a pro rata basis only upon recovery of the investments in segregated portfolio. The net assets value NAV of the segregated portfolio shall be declared on a daily basis. Adequate disclosure of the segregated portfolio shall appear in all schemes related documents, in monthly and half-yearly portfolio disclosures, and in the annual report of the mutual fund and the scheme. A segregated portfolio can be created when a mutual fund issuer experiences a credit event such as a downgrade or failure to pay interest or principal on time. This process is also known as side pocketing. With that, we will end this chapter. If you have any doubt, please ask in the comment section. Now let us start the MCQs.